people, welcome back to our sessions. Today we are going to discuss section 1, chapter 2, inventory and uniform capitalization rules. Let's see what is the first question. Which of the following items are not included in inventory? A. Work in process. B. Goods consigned to the taxpayer. C. Goods out on consignment. D. Raw material. Let's see what is the answer. The answer is B. Let's see why the other three options are wrong. So option A, work in process. Work in process refers to partially completed goods that are still undergoing production or manufacturing. So work in process is part of production process. It is not yet a finished product ready for sale and it is considered inventory. And option C, goods out on consignment. Goods out on consignment are included in the taxpayer's inventory because they're still owned by the taxpayer and have been sent to another party for potential sale. So the taxpayer retains ownership until the goods are actually sold to third party by the consignee. And the last one, which is raw material. Raw material are the basic material that are used in the production or manufacturing process. They are considered inventory until they have been incorporated into a finished product. So prior to being used in the production, raw material are not yet considered ready for sale and therefore is included in inventory. So the correct answer is B. Goods consigned to taxpayer. Goods consigned to taxpayer are included in inventory because they are not in the taxpayer's possession and control. Even so, here these goods are held temporarily by the taxpayer for the purpose of eventual sale. So the correct answer is B. Let's go to the next question. The following methods of accounting for inventory are considered acceptable except A. First in first out. B. Trade discount method. C. Cost. D. Last in first out. Let's see what is the answer. The answer is B. Trade discount method. So let's see why the other three options are wrong. Option A, first in first out. FIFO is an acceptable method of accounting for inventory. It assumes that the first item purchased or produced are the first one sold. And option C, cost. So cost method is an acceptable method of accounting for inventory. It involves valuing inventory at its cost, so which includes all direct and indirect costs necessary to bring the inventory to its present condition and location. And last in first out is an acceptable method of accounting for inventory. It assumes the most recently purchased or produced items are the first one sold. So option A, C, D are acceptable method. B is not the acceptable method. So trade discounts are reduction in the list price of goods or services, but they are not a method for valuing or accounting for inventory. So let's go to the next question. Under the lower of cost or market method, what is the value of the following items that should be included in closing inventory? So they have given item, cost and market value. Let's see the options. Option A 800, option B 1000, option C 1050, option D 1250. Let's see what is the answer. The answer is A 800. Let's see why it is A. So here under the lower of cost or market method, the value of the inventory is determined by comparing the cost of item with their market value and using the lower of the two. Now let's calculate the value of the closing inventory for each item. So product X cost is 450 and market value is 700, and here we have to take lower of cost and market. Here market value cost is less, so we have to take value the inventory as 450, and the other one item Y cost is 250 and market value is 100. Here we have to take the market value which is lower, 100, and item Z cost is 300, market is 250, so lower value is 250. So here we need to take value for each item separately, not as a total. So 800 is the answer. Let's go to the next question. The taxpayer is a merchant who has purchased inventory items. He withdrew some of these items for personal use. He must A. Reduce the cost of purchases by the FMV of the personal use item. B. Reduce beginning inventory by the cost of the personal use item. C. Reduce the cost of purchases by the cost of personal use item. D. Increases sales by the cost of the items withdrawn. Let's see the answer. The answer is C. Reduce the cost of purchases by the cost of personal use item. Let's see why the other three options are wrong. So option A, this option is incorrect because when personal use items are withdrawn from inventory, the cost of purchases should be reduced by the cost of personal use item and not their fair value. So option is wrong. Option B, reducing beginning inventory by the cost of personal use item is not the correct approach. Personal use item are not considered part of inventory and should not affect the calculation of beginning inventory. So option B is wrong. Option D is also wrong because withdrawing items for personal use does not increase sales. It reduces inventory and may have tax implication, but it doesn't directly impact sales. So option D is also wrong. The correct answer is C. Let's see why it is C. So here, when personal use items are withdrawn, the cost of purchases should be reduced by the cost of personal use items. So this adjustment properly reflects the reduction in inventory and cost of goods sold. Let's go to the next question. ABC Corporation, a clothing retailer, showed the following expenses: clothing purchase for resale 72,000, freighting 3,550, freight out to customers 1,750, beginning inventory 55,650. Ending inventory 42,500. What is ABC's cost of goods sold? A 86,900, B 175,450, C 90,450, D 88,700. Let's see what is the answer. The answer is D 88,700. Let's see what is the answer. The answer is beginning inventory plus purchases plus freight minus ending inventory. So cost of goods formula is beginning inventory plus purchases plus direct and indirect costs minus ending inventory. So here beginning inventory is 55,650 and freight and purchases is 72,000. Freight and is 3,550. Ending inventory is 42,500. So cost of goods sold is 88,700. Let's go to the next question. Which of the following items is generally included in inventory? A. Goods for sale that someone else has consigned to taxpayer. B. Equipment used in taxpayer's business to manufacture goods. C. Goods taxpayer has sent out on consignment for someone else to sell. D. Goods in transit to taxpayer for which title has not yet passed to taxpayer. Let's see what is the answer. The answer is C. Let's see why the other three options are wrong. Goods for sale that someone else has consigned to taxpayer. Here, goods consigned to the taxpayer by someone else are not considered part of the taxpayer's inventory. The taxpayer is holding these goods on behalf of the consignor until they are sold. So option is wrong. Option B, equipment used in the business for manufacturing goods is not considered part of inventory. Equipment is typically considered a separate asset and is not included in the inventory valuation. And option D, goods in transit for which title has not yet passed to the taxpayer are not considered part of the taxpayer's inventory until ownership is transferred. So the correct answer is C. Goods taxpayer has sent out on consignment for someone else to sell. So here goods sent out on consignment for someone else to sell are generally included in the taxpayer's inventory until they are sold by the consignor. So the correct answer is C. Let's go to the next question. Which of the following inventories is used when the taxpayer can identify and match the actual cost of items in inventory? A. LIFO method. B. Specific identification method. C. None of these choices. D. FIFO method. Let's see what is the answer. The answer is B. Specific identification method. Let's see why it is B. So LIFO method, this method assumes that the most recently acquired items are first to be sold. It may not be suitable when the taxpayer wants to match actual cost, as it might not accurately reflect the actual flow of goods, but it won't match the actual cost. So option A is wrong. And option D, FIFO method, this method assumes that the oldest item are sold first, so it might be closer to matching actual cost than LIFO, so it may still not provide the exact matching that the specific identification method offers when each item actual cost is known and matched. So option D is also wrong. The correct answer is B, specific identification method. So the specific identification method is used when the taxpayer can identify and match the actual cost of items in inventory. This method involves individually identifying and tracking each item in the inventory and associating its actual cost with its sales. So it is particularly useful when dealing with unique or high value items where each item can be individually identified and its cost accurately matched with its sales. Let's go to the next question. Which of the following method is not one of those generally recognized for valuing inventory? Option A is retail, option B lower of cost or market, option C cost, option D constant price. Let's see the answer. The answer is D, constant price. Let's see why it is D. So option A, retail method. Retail method is a recognized inventory valuation method where the value of inventory is determined by applying a predetermined cost to retail ratio to the retail value of the inventory. It is commonly used in retail businesses. So option A is wrong because it is a recognized inventory valuation method. Option B, lower of cost or market method, is a standard approach to inventory valuation where inventory is valued at the lower of its historical cost or its replacement cost. So this method ensures that inventory is not overstated on the financial statement. And option C, which is cost method, it is also a straightforward approach where inventory is valued at historical cost. So it is one of the simplest and most commonly used methods of inventory valuation. And option D, this option is incorrect because constant price is not a recognized inventory valuation method. It is not a term closely used in accounting or inventory valuation practice. So option D is the answer. Let's go to the next question. To properly value inventory at cost, the cost of inventory A must be increased by a trade discount, B must be reduced by a trade discount, C is not reduced or increased by a trade discount, D includes only the direct cost. Let's see the answer. The answer is B, must be reduced by a trade discount. Let's see why it is B. So here, to properly value inventory at cost, the cost of the inventory must be reduced by a trade discount. So here trade discounts are reduction in the selling price offered by a supplier to a buyer as an incentive for purchasing in large quantities or for some other reason. So these discounts are negotiated between buyer and the seller and are not usually shown on invoices or financial statements. So when calculating the cost of inventory, trade discounts are taken into account by subtracting them from the listed price, resulting in a lower cost of inventory. Let's go to the next question. The cost of inventory must be reduced by A, neither a trade discount nor cash discount, B, both a trade discount and a cash discount, C, cash discount, D, a trade discount. Let's see what is the answer. The answer is trade discount. Let's see why it is trade discount. So here a trade discount is a reduction in the selling price of goods or services offered by a seller to a buyer as an incentive for purchasing in large quantities or some reason. So it it is typically negotiated between the buyer and the seller and are not usually shown on invoice or financial statement. And the other end, cash discount is incorrect because cash discounts important for calculating the final amount paid and are not directly related to valuing inventory costs. So cash discounts affect the payment terms but do not impact the cost of goods themselves. Let's go to the next question. The flower and garden partnership values its inventory under lower of cost or market value method. Under this method, what is the value of the ending inventory? Item M and O cost and market value has been given. So option A 545, option B 520, option C 555, option D 525. Let's see what is the answer. The answer is D 525. Let's see why it is D. So here to calculate the ending inventory value under the lower of cost or market value method, we have to compare the cost and market values of each item, and then select the lower value of each item. So then you add the lower value of each item to get the total ending inventory value. So item M. So here lower of cost and market method, which is for item M, cost is lower, so we have to take the cost 150. For N, cost is 175, market is 180, so here also we have to take the cost. For O, cost is 220, market value is 200, here market value is lower, 200 we have to take, so total comes to 525. Let's go to the next question. Madhuri, a calendar year taxpayer who is self-employed, lost thousands of inventory due to flooding of her warehouse in March 2022. Madhuri was not compensated for the loss by insurance or otherwise. Madhuri deducted the loss by adjusting her closing inventory when she filed her tax return for 2022. Was this a proper method? A. Madhuri must claim the loss as a casualty loss and must amend her return. B. Madhuri must amend the return and deduct the loss on the return for the immediately preceding year. C. Madhuri did not follow a proper method and must deduct the loss separately. D. Madhuri followed a proper method to deduct this casualty loss. Let's see what is the answer. The answer is D. Let's see why it is D. So here option A, Madhuri must claim the loss as a casualty loss and must amend her return. So this option is incorrect because Madhuri is not required to claim the loss as a casualty loss. Adjusting the closing inventory to account for the lost inventory is a legitimate way to reflect the decrease in inventory value. So option A is wrong. Option B is also incorrect because Madhuri's method of adjusting the closing inventory on her current year's tax return is appropriate. There is no requirement to amend the previous year return in this case. So option B is wrong. Option C, this option is also incorrect because Madhuri's method of adjusting the closing inventory is a valid approach to reflecting the decrease in inventory value due to the loss. So she does not necessarily need to deduct the loss separately. The correct answer is D. It is correct because Madhuri's method of adjusting her closing inventory to account for loss is an acceptable and proper way to deduct the casualty loss in this situation. So let's go to the next question. A taxpayer suffered 11,000 loss of inventory when his cooler malfunctioned. So he had no insurance for this type of loss. He shows this inventory on his tax return by taking a business loss on his Schedule C as reflected by an increase of 11,000 in cost of goods sold, taking a loss of 11,000 as a bad debt on Schedule D, taking an ordinary loss on Form 4797 of 11,000, taking a bad debt deduction of 22,000, the amount he would have sold the inventory for. So let's see the answer. The answer is A. Let's see why the other three options are wrong. So option B, this option is incorrect because bad debt typically refers to uncollectible account receivable and is not applicable to a loss of inventory due to a cooler malfunction. And option C, form 4797 is used for reporting the sale of business property, and the loss of inventory due to a cooler malfunction does not involve the sale of property. So option C is wrong. Option D, the loss is related to inventory, not bad debts, and amount of deduction should reflect the actual loss suffered, which is 11,000, not the potential selling price. So the correct answer is A. So when inventory is lost due to a situation like a malfunctioning cooler, it is treated as business expense. The loss is reflected by increasing the cost of goods sold on Schedule C, which reduces the taxpayer's gross income and consequently their taxable income also. So the correct answer is A. Let's go to the next question. Gayatri operates a small basket weaving business as a sole proprietor. She incurred the following expenses during the year. Beginning inventory raw material 5,000, beginning inventory finished goods 10,000, ending inventory raw material 6,250, ending inventory finished goods 4,700, purchases 17,500, fabric used in finished goods 2,350, building rent 12,000, freight in on fabric 300, freight out on sale of finished goods 475. What was her cost of goods sold? Let's see the options. Option A 24,675, option B 24,375, option C 24,200, option D 21,850. Let's see the answer. The answer is C 24,200. Let's see why it is C. First, let's calculate the beginning inventory. So here beginning inventory is raw material, finished goods. So total comes to 35,150 minus ending inventory, which is 10,000, minus 10,950. So total comes to 24,200. So 5,000 raw material plus purchases 17,500 plus 300 freight in on fabric minus 6,250, which is raw material. So here beginning inventory finished goods, it is not related to inventory, so it should not be included, and 5,000 we need to add plus purchases 17,500, and fabric used in finished goods, it is not related to inventory, and building rent is also not related to inventory. Freight in fabrics need to be added. So 5,000 plus 17,500 plus 300 minus 6,250, which is ending inventory. So total comes to 24,200. Let's go to the next question. The FX partnership manufactures garden houses for sale. In the month of January, its sales were 80,000. During that month, the partnership had beginning inventory 0, raw material purchase January 1st 35,000, raw material shipping cost 1,585, direct labor 27,000, factory overhead 6,000, ending inventory 10,000. What is the cost of goods sold for FX partnership for the month of January? 53,585, B 69,585, C 58,000, D 59,585. Let's see the answer. The answer is 59,585. Let's see why it is 59,585. So here beginning inventory is 0, raw material purchased is 35,000. So cost of goods is raw material plus direct and indirect cost minus ending inventory. So here beginning inventory is 35,000 and direct and indirect cost, raw material shipping cost, it is a direct cost related to, it is indirect cost related to inventory. Direct labor 27,000 need to be added, factory overheads, it is the indirect cost, it need to be added, and any ending inventory it need to be deducted. So 35,000 plus 1585 plus 27,000 plus 6,000 minus 10,000. So total comes to 59,585. Let's go to the next question. Farmer Bharat sold a breeding cow on March 8th of the current year for 2,500. Expenses related to the sale were 250. Farmer Bharat deducted 1,000 in cost of raising the cow during the year the cow was raised. What is the farmer Bharat's gain loss on the sale of the breeding cow without regard to the uniform capitalization rules? A. None of these choices. B. 2,250. C. 1,150. D. 350. Let's see what is the answer. The answer is B. 2,250. Let's see why it is 2,250. Here gain is equals to sales price minus expenses. Here the cost of raising the cow is not used to calculate the gain. We should not deduct the cost of raising the cow to calculate the gain. So it is related to the basis calculation. So here gain is equals to sales price minus 250 expenses. So Bharat's gain is 2,250. Let's go to the next question. The M&M partnership constructed a commercial building at a cost of 350,000. M&M borrowed 200,000 to help pay for the construction. The interest paid on the loan was 16,000. M&M also borrowed money to purchase a truck to be used in the business. So the truck cost 30,000. M&M put 6,000 down and borrowed 24,000 and paid interest of 2,400. M&M can deduct dollar in interest expense on its tax return. A. 18,400. B. 16,000. C. 2,400. D. 0. Let's see the answer. The answer is 2,400. Let's see why it is 2,400. Here interest paid on loan was 16,000. It is related to construction of a building, so it needs to be capitalized instead of deducting it as a interest. So it need to be added to the basis of the commercial building. And here the other one, which is interest paid to acquire interest paid on truck loan is 2,400. So this we need to deduct it as an interest expenses, and remaining 16,000 need to be capitalized under uniform capitalization rule. Let's go to the next question. Under the general rule, all of the following require taxpayers to capitalize rental expenses except A. Taxpayer produces real or tangible personal property for use in a trade or business or activity engaged in for profit. B. Taxpayer produces real or tangible personal property for sale to customers. C. Taxpayer's rent increases during the lease. D. Taxpayer acquires property for resale and his average annual gross receipts are greater than 1 billion. Let's see the answer. The answer is C. Taxpayer's rent increases during the lease. So let's see why the other three options are wrong. So option A, this option is incorrect because under the general rule, rental expenses related to producing real or tangible personal property for use in trade or business are generally required to be capitalized. So option A is wrong. Option B, this option is incorrect because rental expenses related to producing property for sale to customer are capitalized, same like option A. And D, this option is also incorrect because taxpayer who acquire property for resale and have average annual gross receipts greater than 27 million, they need to be capitalized under uniform capitalization. So D is also wrong. Option C is the correct answer because an increase in rent during the lease itself does not necessarily require the taxpayer to capitalize the rental expenses. This is not a common reason to capitalize rental expenses. The other option involves circumstances where rental expenses are typically capitalized under the general rule. So option C is the correct answer. Let's go to the next question. Which of the following activities would subject a taxpayer to the uniform capitalization rules? A. Taxpayer produces real or tangible personal property for sale to customers. B. Taxpayer produces real or tangible property for non-business use. C. None of these choices. D. Taxpayer acquires property not for resale. Let's see the answer. The answer is A. Let's see why it is A. So here, producing property for sale to customer in an activity that could subject a taxpayer to uniform capitalization rules. So this rules require certain costs such as direct material, direct labor, and a portion of indirect cost to be capitalized as a part of the cost of goods produced or acquired for resale. So other three options are not related to business or resale. So that's so B, C, D are wrong. Let's go to the next question. On January 1st, Catherine leased property for her business for 5 years for 6,200 per year. Catherine paid the full 31,000 during the first year of the sale. What is Catherine's rental deduction for the year? Let's see the answer. Options. Option A is 24,800. Option B 15,500. Option C 6,200. Option D 31,000. Let's see what is the answer. The answer is C 6,200. Let's see why it is 6,200. So here Catherine rental deduction for the year can be calculated by dividing the total lease payment by the number of years in the lease term. So here number of total lease payment is 31,000, lease term is 5 years. So 31,000 divided by 5 years, 6,200. So the correct answer is 6,200. Let's go to the next question. Which of the following is interest that can be deducted on Schedule C? A. Interest assessed on the past due federal taxes of an individual's business. B. Interest required to be capitalized under the Uniform Capitalization Rule. C. Penalties on underpaid estimated tax. D. Interest charged on employment taxes assessed on the taxpayer's business. Let's see the answer. The answer is D. Let's see why the other three options are wrong. So option A, this interest is generally not deductible on Schedule C because it is considered a personal expense and is typically not related to the operation of the business. And option B, this interest is not directly deductible on Schedule C. It is typically included in the cost of goods produced or acquired for resale under the Uniform Capitalization Rule. And option C, this penalties on underpaid estimated taxes are generally not deductible as business expenses. They are considered a personal penalty and are not directly related to the operation of the business. So the correct answer is D, because interest charged on employment taxes assessed on the taxpayer's business is a deductible business expense on Schedule C. Let's go to the next question. The A1 Bicycle Corporation rented construction equipment in 2021 and 2022, which it used to build a storage facility for bicycle manufacturing parts. So the total rent paid for the equipment was 40,000 and 10,000 paid in 2021 and 30,000 paid in 2022. The storage facility was completed in 2021. What amount of rent expense may XYZ Corporation deduct on its 2022 income tax return? A 40,000, B 10,000, C 30,000, D 0. Let's see what is the answer. The answer is D. Let's see why it is D. So the A1 Bicycle Corporation completed the storage facility in 2021. Since the storage facility was completed and ready for use in 2021, the rent paid in 2021 is considered part of the cost of the facility rather than a deductible rent expense. So the amount of rent expense that XYZ Corporation may deduct on its 2022 income tax return is 0. So the rent payments made in 2021 were capitalized as a part of the cost of the storage facility, and there is no additional rent expense to deduct on the 2021 income tax return. So the correct answer is 0. Let's go to the next question. Which of the following is interest that can be deducted on Schedule C? A. Interest assessed on the past due past due federal taxes of an individual businesses. B. Interest required to be capitalized under the uniform capitalization rule. C. Penalties on underpaid estimated taxes. D. Interest charged on employment taxes assessed on the taxpayer's business. Let's see what is the answer. The answer is D. Let's see why it is D. So this interest is directly related to the operation of business, and it is deductible on Schedule C as a business expense. So with this, we have finished section 1, chapter 2, MCQs.